Good morning, everyone, and welcome to the Commercial Underwriting Show. This is where we learn and we discuss uh, underwriting, whether if it's multifamily or commercial. We're going to have the people here. And sometimes we don't have everybody here that can answer the questions, but at least we're going to strive to get that question answered. So it is 11 o'clock, and I want to welcome everyone here to the Commercial Underwriting Show. Thank you all for coming. So I was just talking with Kenneth left. I guess he'll be back. So I was just talking with Lawrence and I was talking with Richard too. 2025 was a year we didn't close on anything. We underwrote a lot of stuff, but nothing penciled out. It just did not pencil out. Either either the seller was asking for too much and just wasn't realistic with the numbers, or well, it can't be a nor. Really, it can't be a nor because the underwrite is the underwrite, right? Um, what I also believe is that you know how you hear all the time the Feds cut rate for the point, Feds cut rate this, that, and the other. And I think Richard could really dwell on this here. Just because you hear that the Feds cut rate, that doesn't necessarily mean that the bank or Fannie, Fannie Mae, Freddie Mac has to drop their rate by uh, a quarter point or a quarter percent. That's not what that means. Now, and this is where Rich could correct me because when the Feds cut rate, that's nothing but a rate between, if I'm not mistaken, between them and the financial institutions. And I want Richard to correct me on that if I'm wrong.
Yeah, you're right,
So
basically.
yeah, so don't think every time you hear that, oh wow, the interest rates drop. You know, I guarantee you, if you go to some of the bank websites, you'll notice that those rates did not come down. They didn't. All right. Now, I'm not saying that they're not going to come down eventually, you know, as the Feds continue to cut. Yeah, I'm sure the bank is going to see, hey, we could bring our rate down, but don't look for an instantaneous uh, reduction in your interest rate for your property. Richard, you want to dwell on that any just to also put me in line because
Yeah,
I may have been out of line a little bit.
well, you pretty much in line from that aspect of it. Uh, the thing is, lenders have their own cost of capital internally, and then they price out use different indices to price out capital to everybody else. So, depending on what the lender is using to price out capital to the public, the Fed rate could have an effect from that standpoint. So if your lender is using prime, for example, cutting Fed rate will affect you, whether it be up or down from that standpoint. However, if your lender is using treasuries like Fannie and Freddie, life insurance companies, and some banks, then the cut in Fed rate may or may not have an impact on you. For example, prior to this last election, the Fed's cut rate 50 basis points. The prime came down, but the Treasury market responded by Treasuries going up 70 basis points in the opposite direction. So it can have an effect. There's not a one-to-one relationship from that standpoint between what the Fed does and what the Treasury market does from that aspect of it. But you got to look at what they're using to price capital off of, because some use prime rate, some use Treasury, some use other indices to price rates off of. So you got to see what that index is and what affects it.
Exactly. exactly. So, but Richard, can we have the prime and then we have the treasury. What would can you name one or two things that would be affected by the prime? Like
Well, the
would
Fed is
for,
the Fed one affects
would,
the prime.
huh?
So the Fed affects the prime. When they say up or down, that's when prime moves from that standpoint.
Okay, okay. All right, all right, all right. You know what
But
I was
treasuries,
thinking?
they don't
Uh,
affect that. But it
right,
doesn't
okay,
affect
okay,
treasuries per se.
okay. All right. Because what I was thinking, well, let me ask you this. If um and see people, if you don't know, ask a question. Because there's some things I don't know. Okay? So so let me ask you this. When a person get a home equity loan on their house, they put equity out of their house. Is that going to be affected by the treasury or by the prime?
It depends on what that particular institution is using to price their capital off of from that standpoint. Some banks use Freddie Home Loan Max indices. Some use Prime. From that standpoint, it all depends on what that particular institution is using to price their cost of capital off of. But
Ah,
there are a lot because there are
now,
a lot of other indices out there like SOFR and things like that. So it all
right,
depends what they're using.
right. Then we speaking of SOFR, didn't we stop using something to pick up SOFR? You forgot what it was. I think it was
LIBOR,
like
got rid
there
of
you
LIBOR.
go. Yeah, LIBOR. I remember that because I was underwriting and then someone it was Spencer Burton, I think, changed his I may have changed his model to a sofa. But yeah, I remember that. Absolutely, absolutely. All right. So I have a pretty clear understanding. Well, let me ask one more question, and then we could jump into this. Um, Credit card debt is that interest rate on a credit card? Is that based on prime or is that based on treasury, or just like you said before, it just depends on the bank and how they use it?
I don't know the actual answer to that one. I don't look at credit
Okay.
cards. It's just from that standpoint. I would
Okay.
probably say it's probably closer tied to prime to some degree, if I had to make an
Yeah,
assumption.
yeah, because interest rate on credit cards go up and down by themselves. Some people have so much debt and credit cards. So, but all right, great, great, great. So I just want to at least discuss that for a little bit. And now let's just, let's discuss some underwriting. So before I get into anything, are there any questions that you may have that you may need help in or answered? Okay. Are there any questions that you have? Please feel free to ask.
Yeah, I have a question here.
Okay.
When you talk about prime, what you mean?
When I talk about what prime on the interest rate,
Yes, prime. What that is?
oh, you got to, I got to go to Richard for that question. So, so Richard, Joseph said, when you speak of prime, what are you talking about?
It's what we call mostly we refer to as the Wall Street Journal Prime. It's some form of spread over the Fed fund rate that people use to price debt off of, whether it be bonds or well, it's definitely bonds, junk bonds or commercial loans or residential loans from that standpoint.
Okay. All right.
Yeah. Okay. Now, Richard, what I normally do when I underwrite, and I usually get email to me from the Treasury, the the Treasury rate every single day around about 5 o'clock. The email blast will go out, and you open it up, and it goes from I do believe from 1 year to 30 years, and you can see the different rates every single day. So normally, what I would do, I look at the 10-year Treasury, say for yesterday, and let's just say yesterday when I looked at it, the Treasury rate was 5.75. That's just an example, everyone. Just an example. 5.75. What I normally do, I would normally add 2 points to the 5.75, because when the lender gives me its rate, if I'm dealing with the Fannie Mae or Freddie Mac, let me also say that. If I'm dealing with the Fannie Mae or Freddie Mac, usually the rate could be anywhere between a 1 and a 2 point spread from the Treasury. Would you say that that move that I'm making, would you, matter of fact, what would you say about that particular type of move that I'm making, so that I don't always have to go to my lender to see what the rate is?
That's not an unreasonable spot to start at from that standpoint. I guess in the current market, depending on what you're underwriting, you could be considered conservative from that standpoint. If you're looking at agency loans, depending on what you're doing, you're probably somewhere between 150 to probably 150 to 190 over. So
Mhm.
being 200 over, it's a good spot, good conservative spot from that standpoint.
Fantastic, fantastic.
Just
So
general rule of thumb.
right. So now, everyone, if you understand, if you go to uh, the Federal Treasury website, you'll see exactly what I'm talking about, where they have all of the interest rates going from 1 to 30, and then you just look at the 10-year, because the reason why you're looking at, oh, I know I gotta ask Richard this here. It just came to me. So anyway, when you go to the Treasury, you're going to see that there's a rate there, and that rate is the Fed rate. But you need to, if you want to stay on the conservative side, add 2 points to what you see on the from the Treasury, and then, of course, once you finish your underwriting and everything, of course you're going to get it checked out by your lender, and excuse me, and so forth. But like Richard said, that will put you in a safe range. Okay, staying on the conservative side. This is the question now that I want to ask Richard. You may have heard some gossip about it, some news. Have you heard anything about the 50-year? Because I'm starting to hear some noise about the 50-year.
I've heard about it. I haven't seen anything in writing on it or any articles that I really hadn't pursued it because it's more of a residential deal. But from a commercial side, no. But for like a multifamily, there are certain government programs that would take you up to a 40-year amortization. So already, so.
Okay, all right.
But
So go ahead, go
as
ahead. No, you go ahead.
as an investor, a 50-year AM from a cash flow perspective would be great. But you got to look what that actually costs you at the end of the day. So
Mhm.
pay, as a personal homeowner, I wouldn't want to go a 50-year amortization for anything.
Right, right, right. I thought about it, and when I heard about it. The first thing came to my mind was, I always, when I was a realtor, when I was a realtor, um, people would ask me, Dad, what's your thoughts on me owning a home and this, that, and the other? I was into investments, and I was in commercial, but I would say, well, I would say, answer this: how you looking at that house? Is that going to be your forever house? Your ever, 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 and happy ever after? And you're going to raise all your kids in the house, and then you're going to heir it to someone else? You know? And they would say, yeah, that I'm thinking about doing that. I said, well, if you're going to do that, then you can get the best rate, go 30 years, and buy your house. I'll show you. And before I became commercial, when I was into residential, I'll be like, yeah, let me show you. I'll show you a couple of houses. I said, but if you're going to look at this property as an investment, and it's not going to be your forever, ever, 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 ever happy ever house, then you need to look at it differently, not as a consumer, but you need to look at it as, well, I, I don't like when you look at the house, just look at it as I'm not going to stay here forever. Maybe it's 3 years. You want to try to get it, you may not want to go for a brand new house or something that's been totally revamped because that owner is going to push for the max. You may want to look at something that you could put some money into, build up the value, stay in the house for 3 years, and then sell the house. Now, there's a reason why I said 3 years. I'm not going to tell you the reason. You figure that one out, right? You can't stay in the house 1 year or two. Stay in the house 3 years, 3 complete years, then sell it, and you could, take the capital from there, buy your next one, right? Or take the capital from there and elevate yourself. Go from a 1 to a 2, from a 2 to a 4, from a 4 to a 5. I didn't say 6 to a 5, from a 5 to a 7, 7 to a 9. Right. But again, if you're looking at that house to be your forever glory house, and you're looking for that seller to have made every single change in it, and it's just you don't have to do anything or maybe very little, then you're gonna pay top dollar, and you're a consumer. Okay. All right. Any comments or questions in reference to what I just said? Because I would love to hear from somebody about what I just said. Go ahead. Go ahead.
I just want to add a point to something. So in addition to the 50-year mortgage, I've been hearing a lot about mortgage portability, which is basically substitution of the collateral that's used for the original loan. So that's something else that's kind of been proposed or talked about. It's nothing written in concrete or nothing set in stone just yet, but it's something that's on the table that's being discussed.
And you said it
That's also on the residential side as well.
really, and you said that's part of the equity in the house?
I don't know. That's the part that they're trying to pencil out now is how does that actually look? But it's been proposed to, that as an option for consumers that, hey, instead of actually applying for a new mortgage or, whatever that process is, you can take your original mortgage and just substitute the property and move to a different property with that same mortgage.
Wow. I didn't hear about that one. I'm glad you brought that up.
That's been on the table because, in contrast to the 50-year mortgage argument, someone else brought up, well, you can do this instead. And I know both of those options are being talked about now.
So now my question is, as an investor, can either one of those help us? Come on, let's talk about that for a minute. As an investor, can either one of those help us?
I think in the right circumstances, yes. But I wouldn't use it as a blanket statement that, hey, these are good for investors. I think it's just going to come down to each individual situation. Just like, you're looking at a DSCR level, you're going to look and say, hey, does this make sense? Yeah, I don't think it's a blanket statement. You'll really have to really examine that situation.
Yeah. All right. So this is excellent topic for the day. Just starting off the meeting. This is fantastic. We briefly discussed the interest rates, 50-year amortization. Also, Lawrence, what was the name of the program again?
It's a mortgage portability.
Mortgage affordability?
Portability.
Affordability.
Portability.
Oh, portability.
Yes.
Oh, loan portability. Oh, loan portability is the ability to transfer an existing home loan to a new property when you move. Wow. That would be deep. That would be deep. Yeah. How many people, I'm going to ask this one question. How many people right here have a home, but sometimes you say to yourself, I feel locked in and I just want out. Anyone? I guess I'm the only one. I feel that way. Nobody else saying anything.
I've said that before. We bought a home that we bought it as a fixer upper many moons ago when our children were younger, right before the recession. The one, what was that, back in 2009, 8, 9? And we bought it as a fixer upper, and we were fixing it up. But then multiple things started to break at one time, and they were very high dollar items,
Okay.
and we had staggered it out in order to repair it. And I got laid off. So that was tough. We kept the house, no bankruptcy, none of that, but it was just hard. And I remember feeling that way. We ended up selling it as a profit a couple years after. Well, not a couple, a few years after. Yeah.
Right. Sometimes I'm going to get into some underwriting, everyone, but I don't know. Today I just feel like let some stuff off my chest. Sometimes this is just my feeling. Okay, so everyone else is going to have their own feeling. But sometimes I think the push for someone to buy a home, I just think sometimes it's just so overrated. And maybe I feel like that because I'm an investor and I can see past it. I can see through it. Some people say, "Oh man, you're buying a good investment," and I look at it as, well, if I'm paying a note on it, it ain't an investment to me, right? Um, how can my question is how can I make it an investment, right? How can you make it an investment? Because as long as you're paying that note and it's coming out of your pocket, that ain't no investment, right? Okay, so and I, when I was a realtor, I didn't get into that with my clients. And I'm gonna be honest with you, I had very little clients that I had to show a house to. And that was only because of the direction that I went as a residential agent. I went directly to the banks as a residential agent. I'm gonna be honest with you. I didn't feel like dealing with people. I did not feel like dealing with people. I did not feel like taking them out, showing them a house. People that I knew, yeah, I would take the time and all the everything. But man, if I didn't, if it was like, I did not feel like doing it. It was just something about that. I had to deal with these personalities and this, that, and the other. And I'm gonna tell you something. My buyer criteria. No, I don't want to call it criteria. Believe it or not, even as a residential agent, I built my own criteria. It was about 3 to 4 page long. I met with the husband and the wife, if there was a husband and wife. Okay, if it wasn't a husband, I just met with whoever. But I met with you and I filled this document out. I created it myself. We didn't have AI. I didn't have AI. I created that document. That document was 4 pages long. The questions came from, holy smoke. I don't forgot the name of the system we used to use. Can you believe that? It hasn't been that long. But those who are in real estate, you know what I'm talking about. That's where you go in and you put the property, you go in, you look for your properties. All agents use it.
CoStar or the MLS?
The MLS, thank you. Thank you. I was like, did I really forget that? But the questions on my criteria came from the MLS. So I once I filled out that document, I could just go into the MLS, boom, 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 boom. And whatever homes came up, as long as it was there, met that, I would pick 2 to 3. And I would take the client out. And I did. I would take the client to 2 or 3. Now after that, after I take you out to the max is 3. If you can't figure out that which one of them you want, I'm cutting you loose. I'm telling you, my mentor was like, Dow, you can't do that. No, I'm going to do that because I don't have the time to waste, right? And that's how I was, man. I was, and I was glad that and that's really what. Well, actually, I got closer to the banks, and I could tell you a story about that too. But I got closer to the banks, and the banks started supplying me with properties. Once the banks started supplying me with properties, now I was dealing directly with investors. And I met so many investors. During that time, I would have open house. Like, a lot of realtors, they have open houses on Saturday or Sunday. I never had an open house on a Saturday or Sunday. My open house was on anytime during the week because investors will come during the week. I wasn't getting other people. I was getting investors that was coming out during the week to see the property. I sold every property. I got so good with the bank, and I know I'm running into some time here, but I just want to tell you the story for those of you that may be listening and that's a residential agent. I got so good with the bank started letting me rehab the house. They let me do one. I got my contractor out there. We rehabbed the house for as little as possible. Got top dollar on it. I sold that house in less than 7 days. The house was sold. The asset manager at the bank was like, yo, let's do another one. Can you do the same thing? Because now I'm bringing them more money, right? And that's how that's what I was doing as a residential agent working with banks, directly with the asset manager, directly with them. Yeah.
So you asked the question about what we believe as far as being homeowners versus renting. And so I think it really depends on the person and their financial situation. I always recommend having your own home, as long as you can afford. If it's I almost said recycled home or second generation home or something that's not a new build, right? If you have a home warranty, that helps a lot. If you can afford repairs, for things that break back to back to back to back, you can afford that, then get a home. If you can't, then rent until you can. But while you're renting, it doesn't mean that you don't own a home, because just as Daryl said, you can get a home while you rent a home or an apartment and lease that out and the additional income that you get from that, you can save to repair the house. You can save as a down payment for, your first home or forever home. But that's what I recommend.
Excellent. That's excellent. It's excellent.
But I
So
like your approach with the banks.
I'm gonna tell you right now, if there's whoever listens to this, if you're a real estate agent, you are a residential agent, try to connect with the asset managers of the banks. Now, right now, I think things may be a little slow. A lot of homes are not being foreclosed upon. But the time when I got into it, there was a heavy foreclosure rate, and the bank was just taking back properties and stuff like that. In Jersey, we have a tendency of letting homes stay under bank control for 5, 6, 7 years. They just sit empty, right? And so that's enough about that. So anyway, let's move on. Let's ask some. I need to. There was a couple of properties that we were working on. Let me jump over first to Joseph. Joseph, how you doing? You're muted.
I am wonderful.
You're one. Oh, fantastic, fantastic. How are those townhomes coming along?
It was on July. I
Huh?
July.
No, I'm talking about the townhomes.
Oh, what townhome?
The 8 townhomes that was vacant. I think it was was it? It was I don't want to say where they're located, but the 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 townhomes that
No, you
in
can say
Texas. They were in Texas.
that's what I said. It was on July. It was out, and then I have a partner over there, and then he tore it Friday. He tore it Friday.
What he said? What did he find?
It's a wonderful property. There is 2 lots. There is other construction that was that stopped.
Mm.
It's a kind of juicy. And then the 8 units that was a vacant, they have 4 filled.
Okay, so 4 is filled. I mean, there's only 4 vacant now.
Yeah.
Okay. All right. So that's an update. What about the updated T12 and Rent Road?
I got everything update.
You got the update?
Yeah, I got everything update.
Can you send it to me so I could update my numbers?
Okay, I can do that later after we're done here.
Okay, great. Yeah, let's update that. Because that brings in a whole different perspective.
Yeah.
Let me ask you this. Was there a lot, did any of those vacant townhomes, did they require any rehab? The other 4?
They're ready. They are ready. He told me
They're
they
ready
are.
to move in.
Yes.
Okay. All right. All right. All right. So, and the guy that you're working with, he's into commercial?
Yes.
Okay.
And he lives there.
Okay. Well, I wish you would have. You didn't tell me anything. I was wondering what was going on.
No, he didn't talk much.
Yeah, I know.
Yeah.
So let me ask you this before you do anything. Are you going to go after the property?
I want to. I wanna put the LOI in there. But the difference is like the guy wants a certain amount, but we know we can negotiate with him, and then he say that's what we're gonna when the numbers again when we like you said. I'm gonna send it to you, and then we're gonna try to run the numbers again, and then see where we are with the value added, and then see what's where we are, and then put the LOI there. That's what.
Okay. One more thing.
Yeah.
I had mentioned about finding a comparative luxury townhome similar to the ones that you're looking at. Did you find any similar
Yes, close by,
townhomes close
close
close?
by, close
Sim,
by.
great. Send me that too. Okay.
Okay.
Fantastic. Fantastic. All right. All right. So next uh Billy. Let me see if Billy could talk. Okay, Billy can't talk right now.
Hey, what's going on?
Oh, hey Billy, how's everything, man?
It's going pretty good. How about yourself?
All right, all right. I was just wanted to do it just a follow up on the property that you had. How things coming with that?
It's going pretty good.
He's still quiet?
Sorry, can you hear me?
Yeah. Is he still quiet?
He is. My broker just told me that he rejected an offer for 3.4, uh, but he is still looking at still offloading the property.
And where did we come in at? Because I don't remember.
I can't remember, but I want to say 3.1, 3.2, something like that.
I mean, we're not far.
Right, right. I think we were also still looking at like the expenses. I had spoke with my property manager and some different expenses to kind of lower it, see if they were right on point or high or low. Uh, so she did talk with me. She did say that on the payroll, she said
Yeah.
it is a bit high for that size of a property.
Okay.
Um, Trying to get an idea of where we would be at payroll rise, especially since we're paying a manager and there's really no maintenance person there. So
Yeah.
working with her to put together an idea, what ideally could we use for payroll for like maintenance and management?
Okay.
But we're not too far.
So then let's do this. Sound like to me we're not that far. If somebody's coming in at a 3.4 and we coming in like a 3.1, 3.2, let's Billy, let's get together. I got to go to the doctor. I have to go to the doctor after here. But let's try to talk tomorrow and see if we can finalize our numbers and see if we can submit an LOI too.
Absolutely. Sound like a plan. I'm on it.
Okay, great. Heck yeah. Because if somebody coming at 3.4, we like 3.1, 3.2. Yo, let's do this. Let's do this. You get me excited.
Oh yeah, absolutely. And I'm
Yeah.
pretty sure that he's had it for a while. He's ready to get rid of it. So I'm pretty sure he's negotiable. We just got to come into price that's going to perk up his ears and say, okay, let's go ahead and sell. So I'm for it. Let's make
Okay.
it happen. I
Oh
like the
man.
property as well, so I like it. I've gone by there a couple of times. It's really nice. Like the
Right.
updates he's done to it, and so let's make it happen.
Yeah. Oh man. That you know something? That'd be so great to close out 2025 with a property under our belts. That'd be fantastic.
Oh yeah, it would
That'd be
be.
fantastic. Oh man, that'd be fantastic. All right. Thanks, Billy. Thanks.
Are you
Okay.
welcome?
Alicia. So
Yes.
and I went back and I looked at the rent roll, right? So what
Mhm.
I did was the um the rent that had and underneath the rent had the $200.
Uh-huh.
So what I did, I went straight across on each line, right?
Okay. Yeah.
And I noticed that the rubs the rubs were there, this whatever and whatever the other items were there, and
Yes.
those when I added them to the rent, it was equal. So
Yes.
I made an adjustment to reflect the actual rent. I
Yeah.
did not subtract the 200. I
Okay.
used that amount that was there.
Yeah, the 200 only affected two units.
Okay, okay.
Yeah.
So when I did that, the the goal uh for the projection,
Mm-hmm.
they were low. They
Right.
they were low. It looks like it appears that the rents are
Rent
coming down.
decline. Mm-hmm.
So now I'm thinking in my head how to turn
Yeah.
this into a question.
So
Um,
I did go by there.
okay.
Hopefully you saw the photos because I uploaded them. Um, I can't even tell you which day, but go back to my email where I said I
I
sent them. Okay.
I do that. I'll do that.
Okay.
Yeah.
Okay.
Yeah.
Um, everything looked like the photos that they had sent, a part of the
Yeah.
marketing. I did
Mhm.
not see inside of the units. Um, but if the units do, and I will tour that if the numbers are close.
Right.
Um, I think that there may be some exterior things that we'll have to do as far as maintenance.
Right.
But if we don't have to do anything inside of the units, it should cash on day one.
Exactly. Exactly. I totally agree on that. I totally agree on that. Um, the question that I have is this: we all underwrite properties with the concept and with the projection that rents are going to go up. Depending on the condition of a property, there may be some investors that underwrite properties where rents will hold stable for 1 year, 2 years, and then they will take it up.
Mhm.
Then the third underwrite shows rents are on a slight decline. So my question, and this is, I'm trying to word this question. Um, so if you were to, if the rents are going up, that means, okay, so you're going to take, I think I could just go ahead and let me just go ahead and say, so if the rents are coming down, you still want to get the property. How would you price that property? Would you price the property on on a slight decline, say for the first and second year, seeing how much of a decline per year is in the economy that's bringing the rents down? Okay, would you do that? Or tell me what you would do, because I'm thinking what I would do. Okay, and then
So
so go ahead.
if I was unfamiliar with the area, I would
Right.
say, yeah, probably go down a little bit for the first year, maintain for the second year, and then go up the third year. This area, I believe that it would keep either the existing tenants or we would have a list. This is an area that is extremely busy. It does have other apartments around the area, but this one is renovated and unique. It's a one story. They
Okay.
also have like a little patio behind their unit. I think they're individual patios behind their units. I think it's going to hold steady as far as
Okay.
the rent's concerned.
Okay. So So then, on that 5 and when we underwrite, everyone, for those who are aware, when we underwrite, you got your year growth. In our case, and if I'm hearing Alicia correctly, year 1 will be a 0, no growth. It will hold steady right there. Year 2
I
would
would hold
be
steady.
okay, because we want to evaluate to see which direction that is going, right?
Correct.
Gotcha. Year 3, evaluate, see if we can start pushing the rents up. Would you say?
Correct. Yep.
Okay. All right. So the offer on the property, if we see that the current offers as of today on properties in the area, let's say this is just an example. Let's say they're coming in at $1 million. Should we project and decrease our offer based on the economy of the rents going down by a certain percentage to where we could acquire a property? Am I confusing anyone with what I'm saying?
Yeah, I got a question, Daryl.
Go ahead.
Okay, so you're arguing that, like you said, the rents are gonna slide over the next 3 years, potentially, right?
Mhm.
But on the flip side, for a property that has the potential to go up, you don't make your offer higher based on the potential going up. You make your offer based on what it's producing today. What is it? What is the return today, not based on what it's going to do in the future? Because then if you took the flip side of what you're saying, you would overpay for a property for future performance, not based on what the performance is today.
Okay.
Right?
So I like what you said, and yeah, if a property, I like what you said. Number one, is it going to be based off of how it's performing today? Yeah, it will be based off how it performs today. If it's going to be steady or if it's going to be climbing. But if I see that property has a decline, not the property. Excuse me. Correction.
The neighborhood or market.
Thank you. If I see that the neighborhood or that market has a decline, and we could pull up a chart and say, yo, this, this is where it is. This is the lowest. We could look at the trend. This is the lowest it's been. This is where it's going right now. They're starting to, how do you say that? They're starting to level out. The market is, they say that.
It's stabilizing.
Thank you. Yeah. Is it stabilized or how do you say that in the stock market when it's market? Correction. So we look at the trend, but we also know that in certain cities and states, man, those rents were jumping up. They were moving. Right? Could this be a correction? To where now the rents are coming back down to where they're normalized? Now they're stabilized. A correction in the market, right? So Carl, yes, I agree with you. The property is doing well, holding steady, rents climb. I am. But if I see that you're declining, I'm not giving you today's money, and I can see the trend that the rents are declining. I'm going to offer you less. Remember, Carl, and again, you are correct. Okay? You are correct. The market's doing well. The market's inclining. Rent's going up. Yeah. This is what it is as of today. But if I see that market is declining in rents, now I'm not coming in at today's rate. I'm going to have to do a little projection. I'm going to offer you a little less. And in my LOI, there's going to be a cover letter that's going to explain my move, my strategy. Now, Carl, you may not agree with it. When I send it to you, you may say, "Yo, man, that's up to you. If the market go down, that ain't up to me." I'm gonna say, "Okay, great." We'll shake hands and I pray that you sell your property.
Hey, Darryl, how you doing?
I'm okay. What about yourself?
All right. Can I give Carl the flip side of his what he said?
Sure, go ahead.
Okay, Carl, on the flip side, you can have that same property and you look around and there's development in the area. You see brand new buildings going up. You see where the submarket, because that's what we're talking about, that submarket has development is going on. You see retail outlets being built. You see Starbucks coming in there. You see a Home Depot being built. All those retailers have major, major marketing departments, major people looking at where's the growth and stuff is going. I'm a flip side with your answer, what you said. I might just give the seller a little bit more for that property because I intend to do a long-term hold on that property. 30 years from now, I'm keeping it 10, 20, 30 years from now. I see this development. I'm looking at the Starbucks. I'm looking at the other retailers that's coming in. I'm looking at the population growth. I'm looking at the businesses that's coming into that area. So I might just give him the price that he wants because I'm looking to make up that money or make up the equity that I spent on that property on the long term basis. Taking a bet, an educated bet, that with all this going around with it, their property is going to appreciate over time, and I can raise the rent. So I think, like Darryl said, you have to look at each is case by case basis. What is your reasoning that you want? And you go into the property. Of course, we all know the profit is made on the beginning and not on the back end of the property. But if I intend to hold that property 30 years, I'm not really looking at it that way because I'm looking at how much appreciation can I build over the long term based on what's happening now. Can I ride that growth on there? Is I'm at the bottom of the market and the market is going up. So sometimes folks have done it. I'm with a guy now who actually did that. And he went into the areas around the train stations that is the one of the worst areas. But guess what? The development that's going on around the train stations now is amazing. And he was the first one in there. Everybody looked at him like he was crazy. Oh, you overpaid for the property. That is outrageous and stuff. But now he got other people building around these transit villages and stuff over there. So sometimes you have to look at it in a different way, different approach, and what is your exit plan for the property on there? I
Yeah.
hope that makes sense, Down.
Yeah. So Carl, each investor is going to have their own strategy and the way they handle things, right? You know what I'm saying? You have some investors that will, some investors that won't. The property, some investors may not even touch the property that Alicia and I are talking about. Some say, "Oh, I ain't gonna touch it, right? I ain't messing with it." But Carl, once you educate yourself, the whole thing is this: you should there should always be a bunch of questions. Always, you should always inquire, 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 inquire. Why are the rents dropping? What's going on in this neighborhood? Okay, what are the trends? What was it like 5 years ago? Right? Is it possible that no? What happened in that neighborhood that forced the rents to go up the the way they did? Have that settled now? Is there going to be a correction now that the rents are going to start coming back down to the normalization of where they should have been? Right? So whatever strategy the investor decides, I pray that he just thought it through thoroughly. Because, and remember, there is no guarantees in what we do. Don't you ever make a guarantee. You could go to jail. They report you to the SEC. You could go to jail. Don't ever make guarantees. They are investing in your product. There is a risk of loss. But with the education and with the knowledge that we have, we minimize our risk of loss a lot. You cannot foretell the future. If you can, I want to know. But you cannot foretell the future. You don't know what it's going to be like 1 second from now. Well, now it just hit, so it's the past. But you don't know. So you have to make an educated decision. You and your team sit down and say, how would we like to handle this? If the team says, let that property go, then we let it go. If the team says, yo, that strategy, we could put it together, but we're going to have to come in at a lower price because of the way the market is correcting, then we do that. All right. If the market is booming, if you're the type of investor, say, it's just me, so I could take the risk and go 30 years. Or if you're that type of investor that says, I'm going to pay what it's worth today, then those are strategies. And there are many other strategies, okay? So I love this. This was fantastic today. This was fantastic today. Are there any questions, comments in reference to anything that we discussed today? No questions or comments? All right.
I think
So
it
if
was a
there
good discussion. It was a really good discussion of several different areas. So I look forward to next week as well.
yeah, this
Absolutely.
was really great. And I could see two potentials of us going after two properties in 2025. Now, will we close in 2025? Probably not. We may wind up closing in 2026, but at least we started in 2025. Okay. I don't have any expectations. I'm just walking the path. If it goes that way, it goes that way. If it doesn't go that way, it don't go that way. I'm not setting no expectations. Okay. If there's anyone after reviewing this, because I'm going to post this out. I'm going to post this on YouTube, and I hope everyone here has subscribed to the YouTube channel because I posted 2 videos last week. I was behind one, so I posted one. Then I think I waited a day and I posted the other one. But this one here will be posted. Please, for those that are watching this, if you have any questions, please post them in the comment. And for those of you that are watching, share with your friends. Share, like, subscribe. Right? Help us grow. Help us grow the community of the commercial underwriting show, because we would love to help you in your journey. So until next week, I will see you all at 11 o'clock next Tuesday here at the Commercial Underwriting Show. Thank you all and have a blessed week.
Have a good.
Right, appreciate it. Thank you. Thank you.